Nothing today, probably an increase in December, but it's really about next year. So how do you position yourself, and what's the discussion that you have at this meeting to set yourself up for next year? You've got a couple of things. First of all, what's the view of how much slack there is in the economy? The unemployment rate is really low, so there's going to be a discussion again about participation. How much labor is there on the sidelines that you can bring back in? That's a key point of question. There's also a very interesting technical question going on because the Fed funds rate is at the top end of its range, and they're probably going to have a discussion about whether they can do something from the technical side to keep that from bumping up against the top, because there is an argument out there that reserves are too tight, that there's not enough money in the system, which is interesting given how much money there is in the system.
How does that conversation break down, though? I mean, who's got the power in the room right now? Who's making the different arguments, and who wins that argument right now?
Yeah, we'd all love to be a fly on the wall of this meeting.
You used to be in those meetings.
Yes, indeed. So you're going to have the chairman he's going to have the most prominent voice, of course. There's going to be the staff that will have a voice in that. They will be briefing on some of those technical aspects. But the bigger question, again, really is that question about how much slack there is in the labor force. Are we getting to the point where the unemployment rate is so low that you're actually running out of labor, and therefore...
If you were in the meeting, you would say what about, and what would you say the numbers should be?
The number in terms of...
In terms of the slack in the labor market and whether you can actually bring it back.
Well, I mean, my point of view is that actually, we are, pretty much close to running out of labor in the sense that, it's a very tight labor market. The labor participation is growing very, very low at this point, and therefore you are going to be at a point where the data is going to start to slow down later in the year, later next year, that is. By 2020, you're looking at a possible recession. I mean, which would be 10 years of recovery. That's not a bad cycle. That's actually a pretty good cycle, historically speaking.
Can I ask you a quick question about the other side of Fed policy, which is regulatory policy, as it relates to the velocity of money, the stress tests, because there's, in my opinion, there's plenty of reserves in the system, but one of the things that's been a hindrance to a certain extent has been that financial regulation has been very tough. It looks like Randy Quarles wants to ease that. To me, that would, as a stock market person, that's very important. But
you're right about that, and where that's showing up is in the medium and smaller sized banks. That's really where they are dialing back the regulations, and so those banks, if you will, like the mid-sized lenders, the small lenders, they're the ones who are feeling the impact of those changes that Randy Quarles is leading at the Fed. Among the big banks, they're seeing less of it. The Dodd-Frank rules are, for the most part, still there. There has been some dial back of things like the Volcker rule,
SIFI,
some of those aspects for the non-bank SIFIs, but for the bank SIFIs, actually not that much has changed. It may change, and that's something to look forward, because if you're in the administration, how many dials do you have? Fiscal policy with these midterms is probably off the table. You probably can't do another big tax bill, but you can push on deregulation some more. You can push on trade some more.